All right, we have an action-packed video for you guys today. We're going to be looking at 3 of the best 7-ish% yielding dividend ETFs on the market. And this is going to be part 1 of a series. The next video I'm going to be uploading is going to be the best 5% dividend yielding ETFs, and those have different characteristics. Obviously, the income is a bit less, but their growth potential is a bit more. So I decided to separate them into the 7% group and the 5% group. And as we're about to talk about, these ETFs maximize cash flow and they offer downside protection. That's another feature of these funds right here. So if you guys enjoy this, leave the video a like and subscribe to the channel so you don't miss the next episode. And let's do this. Okay, so here's an overview of all the data we're going to be talking about in this video. We're going to be visually showing how these funds operate because I find these graphs very useful, for me at least. I hope you guys are in the same boat. We're also going to be looking into some articles and reading a few highlighted segments to see how these funds operate. Of course, we're going to compare the historical price performance as well as a pros and cons list over here. Now, I'm actually going to begin this by splitting these 3 names into 2 groups. So NUSI and Xrmi are the 2 we're going to tackle first because their strategies are very similar. And we're going to bring Jepi into the discussion a little bit later because the strategy is quite drastically different. And to quickly illustrate what I mean by this, when it comes to these risk-managed, income-focused funds, there's 3 major goals that we all want. We want price appreciation, we want high levels of income, and we want downside protection. But unfortunately, this is one of those situations where you have to pick 2. You can't have all 3 of these in one investment. And that's just due to the realities of the world we live in. Everything has trade-offs. So when it comes to NUSI and Xrmi, the reason why they're similar is because they make the same decision. They both focus on high levels of income and downside protection, while Jepi, on the other hand, makes this decision. They focus on some price appreciation as well as high levels of income. Alright, but out of these 2, let's begin with NUSI because this is by far the most popular between these 2 choices. This article is titled NUSI, Understanding Their Option Strategy is Key to this High Yield ETF. The nationwide risk managed income ETF NUSI is only just short of 2 years old. It is structured to provide income in this low yield environment without using fixed income assets that would hurt when interest rates start to return to levels considered normal. This strategy is also designed to provide the Nasdaq 100 exposure with less risk. The strategy used to accomplish both goals is their protective collar option strategy. In short, NUSI is an ETF for investors looking for income but want to minimize their exposure to the bond market with where interest rates are now and willing to give up unrestricted market gains or losses. This is an overview of the distributions of the fund, which is definitely a key metric here. So the fund employs a managed distribution policy which is similar in nature to comparable option-based funds. This approach allows for smoother distributions to investors. Each month, the fund seeks to pay a distribution that may be derived from a combination of option premiums, dividends, and any appreciation from the fund's equity holdings. Most come from premiums and thus is classified as a return of capital. And here's a little chart showing how most of the distributions are classified as return of capital. Now, I made a whole video on this topic. I'll leave it linked down below. Most people think return of capital is a super negative thing, and it definitely can be. But in a situation like this, most of the dividend is coming from the option strategy. So it's not coming from a traditional dividend source. And in this situation, that is classified as return of capital. Basically, this strategy captures income by writing call options and some market gains, depending on how far the strike prices are out of the money when written. Some of the income from calls is then used to buy put options to protect the ETFs from market downturns. The cost of that protection is related to the level of protection desired. So more protection equals more cost, aka less return. And here are some basic rules of the option strategy that NUSI uses. So it writes covered calls on the Nasdaq 100 index using strike prices near at the money or slightly out of the money. Expiration dates within 1 month to guard against liquidity and duration risk. Call options are typically closed after a defined percentage of net premia has been generated. If the Nasdaq 100 index rises above the strike price, the manager may close the call option early to minimize potential losses. This right here is something unique about NUSI because it is actively managed. It doesn't follow a systematic approach, and that allows for situations like this to occur, and apparently that happened in August. And lastly, hedges the risk of the underlying stock portfolio by buying Nasdaq 100 protective puts. out-of-the-money puts are purchased with some of the premium generated by selling the Nasdaq 100 covered calls. And here's a little snapshot of the current options outstanding. So today, NUSI owns both calls and put options expiring November 19th, 2021. And these are their positions right here. And generally speaking, the put options are about 10% out of the money. So that's how much you can drop within the duration of the put option, which are purchased every single month. All right, so a quick little pros and cons list of what we just went over. So for NUSI, I would say the pros of this ETF is that it's 2020 tested. Just by happenstance, all three of these funds are really brand new, but NUSI is the oldest of the bunch, and thus it went through the market crash of 2020 and it proved how the strategy could work. We're going to look at the historical price performance in a minute, but when it comes to the cons, I would say that this ETF is not fully transparent. So as we saw, management has the ability to close out a call options early. It's also not systematic, so we saw that the put options are usually 10% out of the money, but that's not a systematic rule. It's just how the management usually does things. And lastly, NUSI is only based off of the Nasdaq 100. There's no S&P 500 version, unfortunately. All right, but moving on to Xrmi, the first thing I want to mention is that there's two versions of this exact ETF. So there's Xrmi and Qrmi. Qrmi is based off of the Nasdaq 100 and Xrmi is based off the S&P 500. So right off the bat, it gives you that flexibility. But looking at this summary here, risk managed income strategies typically own securities in an equity index while also selling covered call options on the index and buying out of the money protective puts. This is a net credit collar strategy, meaning it is expected to generate positive option premium income while protecting against market sell-offs, so almost identical to NUSI. One benefit of this strategy is that selling covered calls can generate high income that has little or no interest rate risk in exchange for forfeiting the upside potential of the underlying equity securities. So coming back to this pick two situation, that's what I mean by these ETFs choose to forego price appreciation for income and downside protection. And in this current market condition where bond yields are extremely low, this strategy is very attractive. So in regards to the net credit collar strategy, to achieve this outcome, a risk-managed income strategy typically must write the call option at or close to at the money, while purchasing a further out of the money put option. That's what allows you to generate more money than you spend. In fact, that's exactly what it says here. This way, the price of the put option costs less than the call option sold. And to put it visually, this is what's happening with Xrmi. So the time frame is 1 month, and they sell a call option that's at the money or very close to the money. And the put option is a bit further away from the current trading price of the asset at 5% out of the money. And in comparison to this, NUSI looks something more like this. So the time frame is roughly the same, but as mentioned, it's not as systematic. But the call and put options can be anywhere from at the money to 10 to 15% out of the money. So coming back to the pros and cons now for Qrmi/Xrmi, the pros are the systematic and transparency of this ETF. We know that the call options are always going to be at the money, and the put option is always going to be 5% out of the money. You can also choose which version you want. So do you want the one based off of the Nasdaq 100 or the S&P 500? And this company, Global X, they also have a bunch of other variations of this fund, including QTR and XYLD. Now the cons is that this ETF is brand new. It came into existence in August of 2021, so it's very untested. Also, the put option is 5% out of the money, and that's a lot of downside protection. And as we saw in the article, the more downside protection you have, the more it's going to cost, and thus the less return you're going to have. And if we compare NUSI and Qrmi against one another, we can see that playing out here. So they have very similar price movements so far, but Qrmi definitely has slightly less returns, and that's probably due to the greater downside protection. We can try and zoom out to the 3-month view, but again, Xrmi came into existence right here, so it's not a full fair comparison. But even so, we can see that Qrmi tends to go down less than NUSI, but it also goes up less than NUSI. All right, now the final ETF here is Jepi. And as mentioned, Jepi focuses on price appreciation and income, and thus it doesn't use a protective net collar strategy. Rather, its main strategy focuses on equity-linked notes, or ELNs. An ELN is a principal protected instrument generally intended to return 100% of the original investment at maturity, but deviates from typical fixed income coupon bond in that its coupon is governed by the appreciation of the underlying equity, which is why it's called equity-linked notes. An ELN has fixed income features like principal protection, as well as equity market upward exposure. It is structured by combining the economics of a long call option on equity with a long discount bond position. The investment structure generally offers 100% principal protection. The final payment at maturity, or coupon, is determined by the appreciation of the underlying stock. And when it comes to Jepi, we can see that only about 15% of the ETF is invested in ELNs. The rest are in equity holdings. But this article here should give us a bit more insight on how exactly Jepi operates. So as mentioned, the main components of Jepi are the equity holdings and the ELNs. So this right here is about the equity selection process. So they have a proprietary research allowing the advisor to rank companies according to what it believes to be their relative value. After company securities are ranked, the advisor seeks to create a portfolio with a lower volatility level than the S&P 500 index. And that's important to note. They aren't filtering equities by dividend yield, they're focusing by volatility primarily. At this point, ESG is considered and companies considered to have negative factors are ranked lower. And along with the above valuation process, the following factors are reviewed and incorporated into the selection process. Catalysts such as improving company fundamentals that could trigger a rise in a stock price, impact on the overall risk of the portfolio, high perceived potential reward compared to perceived potential risk, and lastly, the possible temporary mispricing caused by market overreactions. So essentially, they're looking for discounted, low volatility companies found within the S&P 500. Now this bit right here is about the benefits Jepi has from owning ELNs. So it provides recurring cash flow to the fund's base on the premiums from the call options the ELNs write and are an important source of the fund's return. The ELNs may reduce the fund's volatility because the income from the ELNs would reduce potential losses incurred by the fund's equity portfolio. But there are also some downsides to ELNs, and much like with call options, they do limit your upside potential if the market is going through an intense bull rally. Now, with Jepi, the ELN structure and process isn't fully transparent, and that's definitely a negative of this fund. But this is one of the rare insights we have on what's going on with the ELNs. So we can gather from this that Jepi has ELNs from a bunch of different institutions, and the point of that is to help minimize risk in case one of them goes bankrupt. We can also see that the return of these ELNs are linked to the S&P 500 index. And this right here, the 35.6%, I believe is the participation rate. So if the S&P 500 goes up $100 per share, you would gain $35.60 per share. And because of the structure of the ELN, that's paid to you in the form of a coupon, and that's where a lot of the income from the fund comes from. And putting this into a pros and cons list, I would say the biggest pro of Jepi, especially in comparison to these other ETFs, are the equity holdings. And this is going to allow for a lot more price appreciation over the long run. And as we saw, the equities are screened for quality and valuation, which I think is a positive thing. The cons are that this strategy with ELNs is very complicated, and there's not many ETFs that do this, and only time will tell how successful this is in the long run. And finally, because this is not a net caller strategy, there's no direct downside protection. There's no put option like we find in these ETFs. Now finally, putting all three of these names side by side, we can see how they performed over the past 3 months, and generally they move in similar directions. If we zoom out to the past 1 year, Qrmi is too new to really be part of this conversation, but looking at Jepi versus NUSI, we can see how the equity holdings in Jepi allow it to have more price appreciation. Although if we zoom out a little bit more, Jepi came into existence just after the crash in March of 2020, so we do not know how Jepi would perform during an intense market crash. But that's my video in comparison of these 3 very high-yielding dividend ETFs and how they operate. If you guys enjoyed the video, definitely give it a like. Also remember to subscribe to the channel because my next video is going to be on the best 5% dividend yielding ETFs. So stay tuned for that. I hope you guys enjoyed, and I'll see you in the next one.